Hi there, welcome to Kneppy Invest. This video today is inspired by the December quarter Appendix 4C season or month. So I decided to bring you 100 interesting companies that did release an Appendix 4C or 5B that piqued my interest. Bit of a theme today because we're going to be looking at 3 companies that recently listed on the ASX. And these are 3, won't say completely different companies, but particularly 2 of the companies are quite a bit different than the third company. And the reason I like these companies are for various reasons. And the 3 companies we'll be looking at in today's video are Xpon Technologies, X2M Connect, and Aquirian. Now, the reason why these companies did pique my interest are for various reasons. For instance, Xpon Technologies and X2M Connect, we have seen significant growth in their revenue or annual recurring revenue, cash receipts. Now, both these companies are not operational cash flow positive or profitable just yet. And the other thing going against both of these companies is the market really hasn't been all that interested in these companies. And you'll be able to see that when we look at the chart. Aquirian is a little bit different. It is in mining services. In fact, they have 2 divisions, mining services and a people division. And the thing that's a little bit different with Aquirian compared to the other 2 companies, apart from the other 2 companies have X in their name, is Aquirian is operational cash flow positive and profitable, but we don't see quite the growth in this company like we do see in the other 2 companies. And the other thing going for Aquirian compared to the other 2 companies is we have seen the share price grow or increase over the past few months. So there's a little bit of positive sentiment in Aquirian right now. The first company we'll have a look at in this video is Xpon Technologies. Xpon Technologies is a marketing and customer experience SaaS company with 2 platforms. So this is straight from one of their presentations. I think this was a presentation that they released when they IPOed, which was about 2 months from when I'm doing this video, which is the 16th of February. So they did list, I think it was in December, and they just mentioned their technologies or their platforms help their customers modernize their marketing and customer experience through big data analytics, machine learning, and artificial intelligence, supporting cloud infrastructure and technologies, etc., etc. The 2 platforms are Wondrous, which centralizes customer and marketing data, leveraging AI for automated activation. And the second platform is Holoscribe, an extended reality platform for quickly and easily publishing XR and 360-degree content in any supported channel. To be honest with you, I had to look at their website, go through their presentations, and still I'm a little bit unclear on exactly the benefits of what this company does for their customers. However, in saying that, we have seen significant growth in their annual recurring revenue over the past few years, which I'll talk about soon. And even though I don't understand this company, it seems like their customers are liking what Xpon Technologies is doing for them. Now, the whole reason I became interested in Xpon Technologies when they released their quarterly report was this little graph they had in it, which shows you the growth in annual recurring revenue over the past 18 months. In fact, when I initially looked at this, I thought it was the last 2 years, but it starts at June 2020, when the annual recurring revenue for this company was 2.6 million. And they grew that number almost threefold, 527, almost fourfold, not quite fourfold, so in between tripling and quadrupling in 1 year from 2.6 million to 9.2 million. And that growth has continued through the first 2 quarters of financial year 22. In fact, annual recurring revenue seems to be growing about $2 million per quarter, and this is all organic growth. At the end of the December quarter, annual recurring revenue for this company was $13.1 million. Now, a rough estimate I do to get sort of the first valuation or possible valuation of this sort of company, a SaaS company, is just multiply annual recurring revenue by 10. And if you do that, you get $130 million. Now, when I do that, that's not taking into account growth in annual recurring revenue or anything like that. It's a very rough estimate to what the value of a company might be. It's actually worked fairly well in the past and might not be working as well just now because a lot of these SaaS companies' valuations have fallen back by quite a bit. And if we do that with Xpon, you get a valuation of $131 million. And I can tell you right now, the market cap of this company is well below that, particularly when you look at the annual recurring growth, annual recurring revenue growth rate over the past 18 months. You might say there's a little bit of discount to this company right now. Now onto the Appendix 4C for the company. Now the market cap of Xpon is 67 million, so sort of annual recurring revenue, or 5 times annual recurring revenue right now. That's at a share price of 22 cents. They do have $12.8 million of cash and only $92,000 of debt. So the enterprise value of this company is in the $50 million range, almost heading towards not quite $40 million, but around about $54 million. So this company even looks better value when you look at the enterprise value, not the market. Now let's have a look at the Appendix 4C. Receipts to customers in this particular quarter, $2.1 million. And the company is not operational cash flow positive yet. So that is a cross against this company. Operational cash flow negative by $2.1 million. And maybe over the next few quarters, because this is a SaaS company, it seems like management of all SaaS companies love to spend money, love to increase costs, even if receipts are growing at a significant rate, even if annual recurring revenue is growing. They love to spend the money that comes into their door. So there is a possibility that this company won't be operational cash flow positive for a long time. And if this weakness in the SaaS area does sort of turn around, I can see some good value in this company moving forward. And if they do decide to rein in that costs, grow this company receipts and recurring revenue at a quicker rate than the spending, then I think this company is significantly undervalued right now, particularly if they can continue the growth in annual recurring revenue moving forward. One of the rules or guidelines I do have in my investing rule book, or whatever you want to call it, is not to buy into IPOs within the first 6 months. Never buy into initial public offering, because sometimes there's just too much hype around that. And I'd say the majority of times, the pricing of an IPO is not under, it's over for what it should be. So you will see a lot of companies' share price suffer or fall once they have listed on their public exchange. And that has happened for Xpon. We have seen the share price fall from when they listed 2 months ago, so towards the middle, or in the middle of December 2021. In fact, the share price reached a high the day they listed of 28.5 cents. And we have seen the share price fall by about 25% since then. And right now it's at 21 cents. And you can see the share price just going sideways. No interest in the market right now. And there's probably no reason for the market to get interested, because a lot of that growth in annual recurring revenue could be found in their prospectus they did release. So at this point in time, I think the market is waiting for some sort of catalyst to get excited about this company. So at this point in time, even if you do a little bit more research on Xpon and you find there is something interesting in this company, you still can be patient, because at this point in time, share price is going sideways, and what you want to wait is just for breakout in the share price. And preferably that breakout in the share price would be on some good volume. Second company I want to discuss in this video is X2M Connect. This is the Internet of Things for utility companies. Their platform provides seamless end-to-end digitalization with the ability to control a variety of connected devices across most telecommunications technologies. So valves, storage tanks, pumps, meters. They seem to be focused in Asia and Pacific. I won't say they will be looking to expand across the rest of the world, but that's where their focus is right now, particularly talking about South Korea, China, Japan, those sort of locations. That's where this company seems to be focusing their business right now. Sorry, this is a little bit messy here, but this is some of the financial data I did find for X2M from their prospectus, from their Appendix 4E or preliminary final report, and that is the last half, or we'll say 2/3 of this screen. The top of this is straight from their prospectus, looking at the revenue numbers for the calendar year, actually financial year 2019, financial year 2020, and the first 6 months of financial year 21. And the main thing to focus on here is revenue growth. And revenue for financial year 2019, 2.2 million. They grew revenue to 3.1 million in financial year 20. And in the first 6 months of financial year 21, the revenue was greater than the whole full year in financial year 22, and revenue for that first 6 months was 3.2 million. Totally ignoring other income, because I'm just focusing on revenue. That other income could be anything. But the main thing here is that the revenue for the first 6 months of financial year 21 was greater than the previous financial year. And then when they released their Appendix 4E, this would have been in August, they had revenue for the full financial year up to $5.7 million. So the half-year revenue numbers for the second half of this financial year would have been about 2.6 million. But the main thing here is revenue grew significantly from the previous year. And the other thing to take into account is receipts and cash flow from operating activities, which is on the bottom here. In fact, receipts grew from 1.4 million to 7.7 million. There is a little bit of discrepancy between receipts and revenue I found for this company. And the other thing is this company is still operational cash flow negative, and for financial year 21, they were operational cash flow negative by 3.2 million. Now to the reason why I became interested in X2M Connect, and that was their quarterly cash flow report. Receipts and customers, $5 million in this one quarter. Just one quarter, $5 million, which is significantly higher than the revenue we saw from this company even 1 year ago. Now, the company is not operational cash flow positive. They were negative by 1.1 million. Now, that does include government grants and tax incentives of 324,000 and IPO-related costs, which is negative 322. So if you cancel both of those out, operating cash flow is still negative $1.1 million. So the main reason I'm interested in X2M Connect right now is just the growth in receipts we've seen, or revenue we've seen over the past few years. And when we look at the market cap of this company, only $21 million, that's at a share price of 15 cents, doesn't seem too stretched. And with the company being net cash of $2.6 million, which means the enterprise value is less than $20 million, there is some reasons to like this company right now. And if we do see this company move towards becoming operational cash flow positive, say in the next few quarters, this company will be looking even more exciting right now, especially if the market cap enterprise value stays below $20 or around $20 or $20 million, I should say. Now to the daily chart for X2M Connect, and very similar looking chart than Xpon, apart from this goes out a little bit longer. It actually starts in September when this company IPOed, but very similar share price action on the day this company listed. In fact, share price high for X2M was the day they listed on the ASX. In fact, the share price reached a high of 35 cents. And on the day, it actually opened near the high and the share price fell during the day. In fact, the share price fell from 35 cents to about 27 cents on the day they listed. The share price kept on falling over the next month. In fact, it fell from that 35 cents all the way to a low of 14 cents by November. Share price has been going sideways. We did see a little bit of excitement towards the end of November last year. Maybe that was with the AGM or something. We did see the share price pop up, but that was short-lived, that excitement. It was really only a one-day excitement, and the share price has fallen back to the recent low we saw in November at around about 14.5 cents. A potential double bottom. Double bottoms can be bullish, but at this point in time, a lack of excitement in the market, and you can see the lack of excitement with just the very low volumes with this company. So I've put this onto my watch list, and I'll be looking at their future Appendix 4Cs with interest. And if this company can become operational cash flow positive, this could be a buy for me, particularly if the market discovers this company. Now to Aquirian, if that's how you pronounce it. They have two divisions, a people services division and then a sort of a mining services division. So I'll probably consider this company to be mining service because they're two people services division subsidiaries, which is TBS Workforce and Modular Training, are all about helping mining companies. So even though this is called People Services Division, I still consider this to be a mining services. The TBS Workforce is all about employment, and Modular Training is all about education. So employment and education of staff for mining companies. The other division that Aquirian does have is the Mining Services Division, and the revenue between these two divisions are evenly split, 51% for the People Services, 49% for the Mining Services. And just like the People Services Division, the Mining Services Division is split into two subsidiaries, TBS Mining Solutions and Maglock Australia. TBS Mining Solutions is a provider of consumable products, blasting products and lease equipment. And then Maglock Australia is a storage solution for explosive materials and dangerous goods. And both of these division or subsidiaries are aimed for mining companies. So even though they have these two divisions, I do consider this company, Aquirian, to be a mining services company. Aquirian did list on the ASX towards the end of July, if I remember correctly. So I actually did see their financial year 21 numbers just after they did IPO. And there's some of the highlights. And even though I'm not that interested in what Aquirian does, because mining services company seems like there's so many on the ASX, it's just the fact that they have seen revenue growing. It grew 19% in the last year, up to 12.5 million. They are EBITDA positive, 2.26 million, and operational cash flow positive, 1.25 million. So that's the one thing this company has going for it compared to the other two companies I've featured in this company. It is profitable and operating cash flow positive. Just the thing they do is of no interest to me. Now, there are two reasons why I did become a little bit interested in this company. So I'm not interested because of what they do. I am interested because they are profitable, operating cash flow positive in the most recent financial year. And they've continued being operational cash flow positive in the last 2 quarters, albeit a very low operating cash flow. In fact, for this current quarter, only $133,000, but receipts have grown. So it looks like they are growing receipts, revenue at a little bit quicker rate, 3.98 million, so just shy of $4 million of receipts in this particular quarter. And the market cap of this company is not too high, $23 million. That's at a share price of 29 cents. And because they do have net cash of about $5 million, it means enterprise value is around $18 million. And again, for a company that's operational cash flow positive, profitable, albeit on a fairly low base, this company is not too highly valued right now. The other thing, apart from the fact that the company is operating cash flow positive and profitable, that has going for it, there's a little bit of interest in the market right now with Aquirian. So this company has been listed for about, was it 8 months since July? 8 months? 2, 7, 5. The other thing going for Aquirian, apart from they are operating cash flow positive and profitable, is the sentiment in this company right now. And if you look at the chart, going back to when they listed on the ASX in July last year, the share price has turned around. And you can see for the first 2 or 3 months, the share price actually went down. In fact, the share price low for this company was 15 cents, which was reached in October. So it took about 3 or 4 months before we saw the low in the share price. And this, again, is one of the reasons why I don't like buying into a company that has recently IPOed. I do like to wait 6 months at least. Sometimes I will buy into a recent IPO, but I need some reasons behind that. But since that low in the share price in October, when it got down to 15 cents, the share price actually doubled over the past 4 or 5 months. And the current share price of this company is at 30.5 cents. And the share price is in an uptrend right now because the company has been listed on the exchange for more than 100 days. We actually have the 50 and 100-day moving averages, and we have seen a pullback in the past month because the share price reached a high of about 36 cents, and that pullback was on low volume. And so this could be a time to take a position in this company if you like what they do and you like the fact that they are operational cash flow positive and profitable. That's all I have for this video on these 3 interesting companies that have recently listed on the ASX. I have put all 3 companies onto my watch list. Well, to be fair with you, they've always been on my watch list because I have a IPO watch list, and companies don't go off that watch list until there is some reason for them to go off this watch list. So I've been looking at the share price action for all these 3 companies since they listed, and to be honest with you, the only company that has piqued my interest in terms of the share price action has been Aquirian, but I just don't like what the company does. Even though they are growing at a very slow rate, they are operational cash flow positive and profitable. I think in very low margins in the mining services area. Even though we are going through some good times in mining companies, it's not really flowing through to mining services company just yet. A little bit more interested in the other 2 companies, the other 2 X companies, simply because of the growth in annual recurring revenue and cash receipts we have seen over the past 18 months. And if those companies can reach that very important inflection point of becoming operational cash flow positive or even free cash flow positive, I think there is some good value in both those companies. If you do want to have, or you have any questions about either of the companies, 3 companies that I have featured in this video, just leave in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a great day. See you later.